So a very good evening to everyone and welcome to this webinar. This is the first webinar in what we'd like to set up as a series of webinars to explore topics of interest to the AIF industry. So first of all, a big thank you to all of you for taking time to join this. And obviously a bigger thank you to our panelists for taking time out and joining this session as well. Before we go ahead, just set some context for the discussion that we're going to have. Recently there was a report by a global consulting firm in which one of the key findings was that, even within the financial services industry, the AIF segment or the AIF subsegment seems to be a little behind or significantly behind most of the other subsegments from a digital adoption perspective, right? So in theirs, they put a digital performance scorecard, and AIFs were rated at a score of about 15. And in comparison, the full service retail banks had a score of over 50. This is from a digital maturity and a digital adoption perspective. As a technology company, what we found really ironic was that the disruption in most other industries, most industries are going through a technology disruption, and it's actually the AIFs that have obviously seen that, and they're investing in that, and they're actually driving a lot of this disruption. So we found that quite ironical that, they've done this research, and we found out that the AIFs, in terms of their own business practices, the digital maturity is lower than that of the others. The other interesting thing, obviously, and we've got the top practitioners over here, and they can talk about that. Obviously, AIFs have grown quite significantly over the last decade and a half, and the outlook over the next decade seems to be just as strong, that AIFs are going to be growing quite significantly. So, given that, we thought it was really an opportune time for us to look at the topic about technology adoption in the alternative investment management. Now, I'm absolutely thrilled to say that we've got what could only be described as a dream panel for this discussion. We've got two of the leaders in the alternative investment management industry in India and globally, in Mr. Rajesh Sehgal, the founder and managing director of Economies, and Mr. Vikram Gupta, who's the founder and managing partner of IVCAP Ventures. I'm also glad to welcome Smita Jain, who manages the fintech space for Salesforce in India. My name's Anand Narayan Swamy. I will be the moderator for the session today. I am a director at Centralon, which is a digital and data company. We have a presence in Australia, Singapore, India, and the US. The Finate that you can see here is our flagship product. It's a SaaS platform specifically designed for the AIF industry. The idea is to digitize the end-to-end business process for category 1 and 2 firms. And all of this is on a bedrock of AI and cloud native capabilities, which we will use to automate as much of the business processes within AIFs, right? Before I request the panel to introduce themselves and their organizations, just a couple of housekeeping points. First up, please note down your questions. There's a little Q&A tab at the bottom of your screen. So if you can raise all your questions over there, we've set some time towards the end of this discussion for Q&As. So please, as we go on, just put in your questions. We're tracking all the questions, we're collating them, and we will ask the panel. Once we get through the initial set of discussions, we will ask them all the questions that you've raised. So without any further ado, can I request Rajesh first to maybe give us an introduction to himself, to Equanimity as well?
Sorry, I was having some network problem. You're asking me to introduce
yes,
myself,
Rajesh,
right?
If you don't mind. Yes, please. Yes.
Great, sure. No, thanks first of all for having me here, and I'm really delighted to have my co-panelists, all established people in their own field of work. A little bit about Equanimity. It's a new fund that was launched about 3 years back. We are an AIF category 1, investing in early stage technology enabled and technology backed businesses. We are just about finishing our investing from our first fund, and I think this was a time when we realized what role technology can play for our own internal operations as well. So this is a very timely conversation and a timely discussion from our point of view. My background has been that I worked for nearly 2 decades with Templeton Global Emerging Markets. I think why that is relevant here in this conversation is because when you work for a large global, multinational firm like Templeton, technology and leveraging technology in your day-to-day operations is like, second nature. It's part of life. That's how work happens, right? And I think when you move out of those bigger, larger organizations and set up smaller firms on a relative basis, you start missing some of those pieces. And I think what we are doing at Equanimity is trying to bring in as much of that technology piece as possible. Although the scale, the utility, etc., are a very different level. But we can discuss more of that as we go on. Over to you.
Sure. Thanks, Rajesh. Vikram, if I could request you next to just give us a quick overview of, introduction and an overview of IVCAP Ventures as well, please.
Great. First of all, thank you so much. It's great to be here along with Anand, yourself, Rajesh, Smita. Thank you so much. Just a quick overview. We are about 10 years old. We currently manage about $200 million, about 30 companies in our portfolio. We invest across asset classes, or not asset classes, across different sectors, at Series A mostly. And we are, of course, mostly the primary focus is the technology. And my own background, I've actually worked with IBM Consulting in the US. So I learned my technology principles over there. And we're quite excited about the entire what technology can do for venture capital fund management business itself. And I think, as Rajesh said, this is actually a good time, and so this discussion is quite timely from that perspective. So quite excited about sharing my thoughts as well. So looking forward to it.
Brilliant. Thank you, Vikram. And last but certainly not least, Smita, could I request you to maybe introduce yourself and also Salesforce? Obviously, we know the larger Salesforce, but specific to the AIF in tech as well. Sorry.
Thank you so much, Anand, for having me here. Pleasure, really. So I manage the emerging FinServe segment for Salesforce India for the country. And in that, of course, fintech is one of the large pieces really which covers that. But AIF per se, if I talk about that, is one of the sub-segments in the wealth segment, that we take care of. A lot of interesting conversations happening with our customers really in the space. I'm going to be talking about taking some examples as we go through during the session. But coming to Salesforce now, I guess most of us here, we will know that Salesforce is a CRM company. We've been doing that since 1999. From an India story, although we are present in India since a decade now, but our India story really started truly in 2017. That's when our leadership sort of took over in India. And happy to talk about, how Fins as a segment, it's a specific segment for us in Salesforce India. There is a lot that we are doing across different customers, across different segments in the Fins industry. I'll be talking more about it as we go through. So yeah, that's about me.
Thanks, Smita. So I think what would be useful to start with as content in the ground setting is maybe Rajesh and Vikram. I'd request both of you to let's start first with talking about what your current technology landscape is within Equanimity and within IVCAP, right? Because that would give a good perspective in terms of where you are currently, what you've already planned for what to do next, and then later on we can talk about what you think will happen well after that, right? So I think I'd request Vikram, maybe if you can just talk us through what your current technology landscape is within it, and what would also be quite interesting for us is if you talked about the drivers. So over this period of time, let's say over the last 18 months or 20 months, have there been any changes in how you're thinking, etc., has evolved over this time period in terms of your current landscape before we get into future plans?
So I think, of course, we are investors in technology companies. So I'll talk about it more from the perspective of how we are using technology at IV.
Yeah.
So my fundamental view about how our own industry is going to evolve over time, I believe that given the quantum of the number of startups out there, and the number of startups that you have to typically evaluate, and the number of investors that you have to manage over time, and the kind of compliances and the interactions with the investors and the entire processes that you follow, it's a very interesting thing that there's a lot of, I think 70 to 80% of the activities that happen can be standardized and can actually be created through a platform, through a model, which over time can then save a lot of hours, of the teams. And typically, as you know, the VC teams or even private equity teams are very small in size. You cannot manually manage everything, right? So quite a few things you have to outsource, and quite a few things you have to try and manage within the bandwidth that you have. So therefore, one has to really work towards automating as much as possible. And we realized it early on. In fact, our whole conceptualization of Ivy Cap was built around the entire ecosystem of the alumni of the IITs, and there are about 500,000 alumni. The first year itself, we had reached out to 75,000 alumni. And what we realized was that, given the amount of response that we received, it was humanly not possible to kind of manage those kind of interactions and and then pay attention to the kind of details behind those interactions. So over time, we realized that we needed a platform that has to be able to support this entire systems and processes. We evaluated quite a few in the market. We looked at almost every platform which was at least pitching itself. And I think there were hardly any at the time when we started setting up our funds. I think over time we've seen a few come up. And we just couldn't get the kind of platform that we were looking for. So what we did last year, in fact, we put together our own team with our own kind of thought processes behind what should go into this entire process, right from the deal sourcing to the deal evaluation to the portfolio management to the exits, and managing all the interactions with the mentors that we have. In fact, our first platform we created was in 2015 called Ivy Camp. If you go to ivycamp.in, you will see a curation platform of startups. Over last 10 years, we would have seen almost over 20,000 startups which would actually come on the platform, of which 3,000 have been curated based on a scoring system. And there's a scoring system based on our learnings, and that is primarily a rejection platform. And then there's, after that, there are certain other parameters that we do. But what we started last year building is actually something even more interesting, which is actually building a complete investor interaction platform. And further, in fact, portfolio management, and we've actually started a mobile app, which actually investors are using now, where they can see their everything related to their investment, and all their documents are available in one place. Whatever is happening at Ivy Cap, our portfolio views, everything is there through a single platform that they can see. And all this we have built ourselves in-house, and I think we feel quite good about it, because we could actually build it the way we thought we wanted to operate ourselves. Of course, there's still a lot of work to be done, but I think we are, I would say, 80% there, and we're quite excited about it.
There's a few really interesting points over there that I want to pick up with you just after this. But Rajesh, if it's all right, if you want to just give us your views as well in terms of current state where you are, and what brought you to the current state as well.
Sure. No, I think Vikram has made some very relevant points. So let me not repeat the whole thing again. I'll just give you some differences, and which essentially crop up from their journey from when they started and our journey, because we started much more recently. As I shared in the beginning, it's been 3 years, little over 3 years since we started. So we're still early in this whole adoption of technology processes internally. Some of the points are pretty common, right? So we see thousands and thousands of startups on a yearly basis. I'll share some numbers with you. So this year, we're in the 7th month. We've already seen nearly 2,500 startups pitch to us. When I say pitch to us, I don't mean we physically have met 2,500 people, won't be possible. But that's the kind of funnel we are talking about. And I think technology plays a very important role in automating the process. So first you have to have a process. And I think all investors will have their own processes and own idiosyncrasies about how they go about, filtering out companies they want to spend more time with. What we have done is when we started off 3 years back, we went to, the mother of all technology, Google, and became loyal customers, used everything that they had to share with us, and it worked beautifully for us, to say the least. But I think as you grow and as there's more history and there's much more aspects to your business as it grows. I think it becomes very important to have some technology that is suitable and like customized for what you are doing, right? You cannot be on a very generic platform. We did the same exercise that Vikram shared earlier. We looked around, met everybody, who else is doing what, etc., etc. But there's always, no one suit fits all. So at the end of that exercise, we, I think, decided to go with someone who is able to build it for us the way we want it, right? Very similar to what Vikram shared earlier. The only difference is, they've done it in-house, and we've outsourced. And I think that also flows from our actually organizational philosophy of outsourcing everything other than the investment function. So at Equanimity, we outsourced everything other than the investment function. So our office, it's a small operation. We are 8 of us now, all investment related professionals, and everything else, you can think of is all outsourced. So our reliance on this external partner to build the technology for us is very high, and therefore we took our time to figure out who that agency should be, or what kind of people we want to work with. And I'm happy to share on this platform that Finid has done a great job for us, even though we're still in the late stages of implementation. So I really don't have first-hand experience of Finid to share, but we've gone through many iterations. The team has gone through many iterations. And so far, what we see is really good, and we can discuss more of that as we go along.
Sure. Thanks for that. So it was really interesting. A couple of points I wanted to touch with both of you before I come to you, Smita, is, I like to think about technology in terms of the stakeholders that get impacted by it, right? So when you're looking at adoption of any technology, you're going to look at that. And what's quite interesting is you've got obviously your internal, when we talk about automating business processes and stuff, there's the internal efficiencies in the stuff you have there. But you've also got two, apart from that, distinct set of audiences that I could see, right? With the volumes that Vikram, you spoke about, 500,000 alumni, 75,000 in the first year. And Rajesh, you talked about 2,500 startups making a pitch to you. So I see there's one almost sort of mass market engagement platform that you'd need, whether that's a rejection basis. What you want to do is sort of find those, diamonds in the less polite thing, right? So you're looking for that over there. So once you want to have that engagement where you don't want to miss those diamonds in the rough, right? Like for whatever reason, because that's what obviously your business is on, that 10x, 100x growth that you'll get with this. And then the other side is managing the actual, it's obviously a very serious business. The returns have to be managed really carefully. There's finances involved, and there's actually the making sure you engage with your investors, putting it in. They want to see transparency, they want to see accountability, they want to see all the correct controls and processes in place as well, and obviously the regulators as well. So what I'd like to do is maybe let's touch upon first, as you go through in the technology adoption. My first question, I suppose, is where, if you had to direct your technology spend, right, there's obviously prioritization decisions you would have to make. So where would you direct your primary technology spend? Is it towards the regulators because they are getting more demanding and there's more scrutiny over there? Is it towards managing your investors and their expectations? Or is it more in terms of making sure you have a broad engagement platform with all the different startups and people, ventures that are coming into you for the Series 1, Series A sort of financing? How would you sort of rank your priorities between these stakeholders?
You want me to?
Vikram, if you'd like to go first, yeah.
So I think it's very important. First of all, I think compliances and everything around regulations, and there's so many of these things that are important. And I think And these things also keep changing, and a lot of this you don't have an option but to outsource as well, right? So even if you have a technology platform, and especially in our case, for example, if you build something in-house, we still need somebody to kind of manage that, who keeps updating the platform with all kind of regulatory changes that keep happening from time to time. And then regulatory changes happen all the time, and compliances, and any filing of forms, and every investor, every transaction that happens there are lots of documentation involved, right? So the key here is that, as I said, maybe you can automate 80% of the processes. You still need that delta 20% manual intervention. And I think maybe over time things will become more and more standardized. I think the regulators themselves are evolving right now. We see various updates of the things coming up from SEBI, from RBI, and lots of things keep changing. So I think as the process is evolving, even if somebody's built a software, if you have to use an external software, even they will have that challenge. That's, in my view, a very fundamental and very critical area of investment from a venture capital, private equity perspective. Very, very important, right? So it's a necessary evil, as I would call it. You don't have an option but to make sure that you're compliant from all the perspectives. So therefore, your first investment has to be that, right? I mean, there's no doubt about that. Then, of course, then it comes to bringing operational efficiencies in terms of your deal sourcing, efficiencies in terms of your due diligence, and how do you make sure that once you've made the investments, how do you manage your portfolio, and how do you help your portfolio with their own fundraisers? And we are actually trying to automate quite a bit, and we believe that we've been successful in doing that. For example, just to give you an example, there are, let's say, these 300 odd investors out there, right? We probably know now each of these investors, their investment philosophy, and especially if you're looking for a next round investor in one of your companies, your system should be able to tell you that, these are the top 10 investors who your portfolio company should reach out to. Why should you even if you are going with the banker, for example, the bankers many times don't know. If your system is able to tell you that, let your bankers follow up only with these 10 companies or these funds who are the right targets for your portfolio companies, that saves a lot of time and makes it very efficient in terms of, raising funds. Similarly, I think same thing for portfolio, or selecting investments, and everywhere, I think you can make it so efficient that, your value can keep increasing the more automation you do. And I think therefore there's a potential for generating much higher returns for your investors when you actually, build a platform like that. So that's where, I believe that this will evolve more and more as we move forward.
Okay, sure. So if I can summarize, then you're saying as a financial services company, obviously, one of the key things is you have to give confidence to the regulators, to your stakeholders. So having that backbone, right, that's clearly first step, even before you set the AIF, but that's the first dollar of technology spend that you'll put it on. Once you've got that right, the next is the engagement with your different stakeholders, right? Whether that's from a deal sourcing perspective, then going through the life cycle with your portfolio management, and then the ongoing investor management, not just for your first fund, but you want to maintain that relationship with the investors in fund one, so that when you go to fund two, it becomes a seamless or relatively more seamless interaction with them. You're keeping them updated and they have more visibility of everything that you're doing on an ongoing basis. Very, very interesting. Rajesh, sorry, any thoughts from you?
Yeah, I think so. I think all the if you look at a fund as the center, there are, I think, 4 constituencies that we typically have to deal with. In my view, each of them are as important as everybody else. And of course, regulators being regulators, our internal KRA is that you should never slip up, right? So you have to satisfy regulators, and there's no question about that. So in addition to regulators, there are these startups and founders and businesses that we're evaluating, which is another constituency. Third is our investors. They're equally important. Timely information, quality of information, feedback from them, questions, answers, FAQs, all of that is extremely important. The fourth is a very generic kind of a bucket. Let's call it intermediaries. We deal with a host of bankers and brokers and all whatnot. And I think technology that, in our opinion, is something that should cater to all four of these constituencies seamlessly. Because, even though any of these two buckets don't talk to each other directly, there's a lot of information that has to flow through the fund structure from one party to the other, right? And I think a successful technology implementation should take care of all of this. As I said in the beginning, at Equanimity, we, given our philosophy, it's all outsourced. So for communicating with regulators, we've appointed an agency. They are the best in the market. They manage all of that for us. And like Vikram highlighted, there's a big risk if you try to do it in-house and you're not able to, keep pace with current changes, and the changes on the regulatory landscape are so, so fickle and so nimble and so many, that's virtually impossible to keep on top of it. So you need to outsource it to somebody whose full-time job is just doing that. So we've done that. Communicating with investors, they are our lifeline, right? They are the oil that flows through, or the blood that flows through our veins, let's say. If there's no capital, there's no business. So catering to them in a timely manner, as I said, quality of information about the portfolio, about individual deals, etc. All of that has to flow from the system. As much as we can automate all of this, it takes away our involvement in terms of time, resources, attention. Out of this, things can be automated and really focus on what is our core. As I shared in the beginning, we feel our core is investments, and the investment, setting the portfolio together. The way we look at it is, let's say 1/3 of our energies should be dedicated to finding out that diamond, in the rough, like you said. Yeah. But a bulk of our effort really has to be going into post-deal monitoring. Once you put a portfolio together, by nature, we invest in very early stage companies, and there you really need a lot of handholding. The more you help the company, the more you work with them, the more value you create for everybody, who's involved in the process. So how does this technology system that we've implemented helping us in that part? How much of that can be left to automation? How much of that is really gut? Because, as you understand, in the investment field, you just cannot automate everything. There's a lot to this. It's not just science. There's a lot of gut feeling here. The system wants us to differentiation. So as much as possible, and I think I would agree with Vikram when he says 80%. So it's always 80-20, right? The Pareto principle. I think most of the activities can be automated and should be automated, allowing you to focus on the other 20%, which results in 80% of your upside. So this is how we look at technology, and this is exactly what we've done in-house.
So I think, Smita, if I can ask you over here to step in, so if I can summarize over here, the thing about the AIFs, I suppose, just looking at listening to what Vikram and Rajesh have said, is that it's fairly complex in terms of, so we talk about low amount of digitization, etc., but it does make sense in some sense, in the sense that they've got almost the same set of stakeholders, same kind of technical complexity in many ways that a large bank would face as well, right? So while their operations are a little different, they have to manage almost the same set of stakeholders. You've got a mass market base with like a depositor, which is going to be here, the people soliciting with different ideas, etc. You've got the investors, you've got the regulators. So, when you listen to this, what's your view, what's your reactions in terms of what you've heard from a platform perspective, if I could put it that way?
So, I think it's quite clear from Vikram, Rajesh, both of them, the problem is the same, really, right? I mean, that we are core, meaning these people are, what is their core? The core is investment, right? Everything which is on a periphery, whether it's communication across the four entities that, Rajesh mentioned for a fund, or whether it's servicing, whether it's making sure, all the documents are really so whether it is doing any analysis, insights, etc. So how we position ourselves is, you do what is core to you, and everything around the four entities that Rajesh mentioned, that you can leave on to us, when it comes to, let's say, communication side of things, that is not core to you, meaning we will give you a platform which has got a ready-made sort of things, which will help you do that. Making sure the investor profiles or the companies that you're investing in, all the profiles are really there in the system, and there is a central repository to take care of that. Managing the complete fund life cycle really onto us. So as I said, you do what is core and leave everything around a platform, maybe like a Salesforce platform, wherein everything else can be done on us. Another important point that I want to touch upon, which Rajesh mentioned, is that build is important, right? Because there are things which are changing very quickly in this ecosystem. What I just want to specifically talk about is that our platform is low code, which essentially means that the two challenges which we have seen most of these smaller organizations or smaller smaller fund houses, where there are no big technology teams taking care of any implementation per se, is the platform being low code, which essentially means the system is extremely agile, can be changed in hours. We're not even talking about days and weeks here. So so that's what we talk about. You focus on what is important to you and leave the rest on to us. That is what Salesforce brings.
Sure, thanks. Just coming back to, I think, Vikram and Rajesh as the industry practitioners. I think so we've talked about like each of you, when you set up your fund, what your priorities are. And it's quite interesting that there's a contrasting view as well, right? Vikram, if I can say this, you've been in a conscious decision to invest more in in-house capabilities and build some of these systems internally yourselves. Whereas Rajesh, you've taken a contrary view or a different view, where you've said you're going to focus all your time within the core investment space, and then you'll find outsource partners that you can put it into each of these, right? What I think would be now really interesting to see is hear your thoughts between the two of you on how these are, how this will impact you in the future as well. So, one of the things we're seeing globally is that post-COVID, the amount of emphasis on digitization of all kinds of processes has obviously increased significantly, right? I'm sure you're both, as part of your investment portfolios and things like that, that's something that you're quite obviously aware of. I just wanted to maybe ask you to think about, with the impact, do you think that COVID and what's happened here is going to have any impact in terms of how you think about technology investments and adoption within the AIF? And if yes, what do you see as the trends that will come up over there?
In fact, this is quite, almost everybody now knows this. COVID has really accelerated the digital adoption across different sectors. And for example, in our case, obviously there was a lot of physical interaction with investors that used to happen quite regularly. Go meet with them face to face, even while doing deals. Unless you meet the founders face to face, this intuition that Rajesh is talking about. So you don't get that intuition unless you look eye to eye. The founders, the team, you don't get that conviction otherwise. So I think what COVID has done is actually changed a lot of that in the last year and a half. And I think people were not comfortable doing that earlier. Now they realize that you can still do deals even on Zoom. You can continue to interact with investors on Zoom calls. You can raise entire funds on Zoom call. In fact, some of the funds I've heard raising $200 million entirely on Zoom. That's unheard of, right? I have not seen that anything like that before. So I think it's a great transition which has happened from previous prior to COVID and now after COVID. But I think the real thing lies somewhere in between. I've started meeting. In fact, I'm sitting here in Delhi right now and meeting a few investors, and we're in the middle of raising our fund. While existing investors, we didn't have to really, even go and meet them, and we didn't even have to make a pitch. They're all, as soon as we announced our fund 3, they're kind of just coming on board. But when you're bringing any new investors on board, right? So you have to even after you make the pitches online, you have to make sure that there is at least that comfort. And same thing on the deal making side as well. We have made transactions during COVID times, and quite a few of them. We've done 3 exits in March, and quite substantial exits, right? So we actually returned 510 crores in the month of March itself. One of them was like a pretty substantial exit. So things can happen, even during COVID times. But I think, over time, obviously things will start, I guess, coming back also in the real world, where people will start going out. There is this thing about people want to travel, right? They want to, this is one of the things that is also human nature. I want to travel and go out and meet with people, right? So even if things get done online, you still want to go and meet people. So I think that is something which will continue to happen as we move forward. And the technology has now proven that, a lot of it can be automated. And I do subscribe to the view, and quite a few reports have said this, that there could be a time when computers can just decide even the intuitive side of investing. So that's a very interesting view, but I think it will take a lot of time before we get there. But I think probably you will see some of that also happening sooner than later. I'm not saying maybe 10 years, maybe beyond 10 years, but it will happen at some point. But technology is going to play more and more role in our business.
Sure. Rajesh, any thoughts?
I think more or less I'm in sync with Vikram's point of view about technology, playing an increasingly important role. And at some point in time in future, it may actually be the dominant role. I wish, I just hope that I am done with my life till then, because otherwise nobody's going to pay me fees. Yeah. Yeah. But I think on a serious note, I think, you asked about whether COVID has had any impact or positive, negative, whatever. So, I think like everything else, there are both sides. On the positive side, I must say that a lot of processes, a lot of interactions with, these 4 constituencies that I mentioned in the beginning have really become online, right? Life has become easier that way. Travel is being cut out. People now accept, an interaction like this. I mean, imagine 2 years back, we wouldn't be doing this on Zoom. We would be in some hotel conference room somewhere, 4 people, hundreds of people in the audience. It's all changed, and we've accepted that, very, very easily. It's come so naturally to all of us. Will this change as humankind wins its battle against the virus? I think it'll go back to how it was, but not 100%. There's things that you could still do on Zoom, you would still continue doing on Zoom. I mean, like Vikram said, he's in Delhi now, right? I'm sure he's there because whatever had to be done on Zoom was already done. Now he has to be there. So I think things will change. Things have changed for good. Things have changed, and I think the faster we all accept that, the better we'll all be placed. In terms of our understanding of technology, our implementation or use of technology in-house, I must say has not changed much, because we were anyway, believers that technology has to be rolled out. It has to play an important role. It has to free us from what all processes can be automated, to focus on that 20%, that I mentioned earlier, which delivers the 80%. So there's been pros and cons, and I think, I'm really delighted to say that, all of us on this call, you, me, participants, everybody just accepted technology with open arms, and we are so comfortable with this now. Yeah.
I want to drill down a little deeper with you on one aspect, right? You talked about how, because through the Zoom meetings and things, we've spoken about a lot about, investor interactions or, startups pitching and stuff. But that's, as you said, 1/3 of your time, right? So the other 2/3 are in terms of managing the actual post-funding, how it's progressing and things like that. So what do you think has there been an impact on that, the lack of travel especially, or do you now see that it's more efficient to actually track how they're doing in terms of how they're managing their assets, their business, and how you track that? Because that's obviously, this is probably the more flashier or the lower hanging fruit in terms of the interactions, but as you said, that's 2/3 of your time, right? So that's where you'd want to see the impact of technology, and that's where there's a bigger bang for buck as well, in more I would say, specialized technology perhaps than just a Zoom or something of that sort. So have you had any thoughts in terms of that 2/3 part of the business as well?
You want me to go first? Yeah, sure.
Yeah, sure.
No, it definitely has. See, the way a very simplistic way of understanding this entire thing is in terms of a food chain, right? We as investors are just a small part of this entire food chain. The value that we all seek to create comes not from only from what we do, but also from what our portfolio companies, the founders, their teams do on the ground, right? Even though we invest in technology businesses and technology enabled businesses, for those businesses to really succeed, somebody somewhere is on the ground doing stuff. Yeah. And if we think that we have to play a role alongside them, shoulder to shoulder, trying to create something to change the world, we have to be there in the trenches with them at some point in time. Even though we are not operational investors, we don't build businesses ourselves. But if we have to in any way even imagine that we can help them, we have to first understand, their life, understand their processes, understand their problems, and only then we can add value. So I think I'll revert back to my original hypothesis here, that as much as we can use technology to get that part, that core of helping companies grow, technology is definitely helping, but it cannot take away from the fact that you will have to step out, you will have to be there on the ground, and you will have to spend good amount of time with your companies to really make that impact.
Sure. Just taking that a little further, Vikram, an interesting point that's come out from what you've said is you've obviously made significant investments internally within technology, building your own team, etc. Right? So just taking Rajesh's point further also, do you see, maybe it's something you do right now as well, Ivy Cap Ventures actively participating in technology decisions that your portfolio companies will make, right? In terms of guiding them in certain technical architecture decisions or technical design decisions, things of that sort. So is that something you already do? Is that something you foresee that given the capacity you're building, that's a value add or something that, your portfolio companies will utilize as well?
So we are actually quite active investors. We invest at Series A stages. That's our sweet spot. And the reason we invest at Series A is because that's the time when you get the maximum stake in the companies. We don't invest without a board seat. We also have a mentor trust where we actually bring mentors. We have a mentor clause in every investment that we do at Series A. So there's a very active engagement with our companies. And of course, we like to look at things that need to be done better, including technology. Of course, we look at people, technology, processes, overall strategy. We look at marketing. We look at lots of things. And all that is done purely with the view to support the teams and see if we can add over and above what the teams are already thinking. And we believe that at Series A stages, these entrepreneurs need a lot of support because, they're still not fully mature. They're still trying to build their teams. They're trying to, as they're scaling up, this is the first time they would have raised a check of the size of $3 to $5 billion. They need to make sure they have their own checks and balances and controls in the system to use that capital properly, and lots of things. So, but at the same time, I think, the challenge that is typically there is that they're so focused on, their own business metric that they tend to many times not look at things which, at times are important. So for example, Smita made a very good point. Technology can be non-core to many businesses. Where use of technology can actually support your business to do things that you're really good at doing. But the businesses that we invest in, the core part of the technology, which is the platform itself, etc., is very core to the business itself. Right? If it's an e-commerce platform, that platform itself is core. But any technology related to compliances, reporting, or investor management, things like those may not necessarily be core. So one can identify those areas, and the advantage that we have is, we in the entire portfolio we can see things that are working in some places and things which are not working, and we can quote examples of, look at this company and how they're leveraging technology, and why don't you do something similar. So we do play that part very actively, and in the process we are able to influence decision making there, and entrepreneurs take it very positively, and we don't enforce things on them. We don't tell them that, hey, you have no option but to do it. I mean, we typically have affirmative rights, which means we have right to say no. We don't tell them what to do. We tell them what not to do, basically. So that's the way we manage their business. So which means that they're trying to do something which we believe is not the right thing to do, we can tell them not to do it. But we cannot enforce something on them that we believe that they have to do and they have no option to do. So that's the way we.
Fair enough. So on that point, maybe Smita, I want to bring you in as well, because you obviously, as a day-to-day basis, you engage with fintechs on the other side of it, right? In terms of technology discussions, etc. So what's your sort of perception of this? Because you hear from the fintechs, perhaps how they manage the investors as a stakeholder to them, right? So any thoughts on that from your perspective?
Yeah, so our pitch largely remains the same with them. And I think what a change that we are seeing, not a change really, but a lot of them follow each other as well. I'm not sure what's the reason behind it, and probably I would want to hear that, from Vikram and Rajesh. But in the fintech space, a lot of them want to know, for example, a lending firm, okay, how many other lending firms have you done and what have you done for them, etc. So it works for us, of course, right? That, I mean, we can replicate a lot of those discussions, and it's easier, and our portfolio, our logos get bigger. But that is what, that's what happens in the fintech space. And yes, I do agree with Vikram that the core stack, they would not ideally want to build on us, right? Because that is what their business is. Why would they want to sort of I don't know, create on a ready-made platform, etc. That is what their brain and their IP, etc. is. But anything around which is managing their something which is not core per se, which is, let's say, managing their customer 360 view, or customer communication, or a lead flow for them, or servicing those customers, or query management for those customers. So I think that is a space that we work very well in.
Brilliant. So what I will do is, we've got about 12 minutes left. I've got a few questions, a series of questions here. Some of them seem fairly large as well. So what I might do is, I might take 2 minutes to actually run through those and collate those questions. So for everyone attending, maybe if you could give us a couple of minutes, to the other panelists, if you'd like to grab a glass of water or get something to drink. We'll play a short video. Let me just try and run through the questions, and then I'll ask each of you some of these questions, and we can try and wrap this up on time in about 11 minutes from now. Cool, thanks. Right, brilliant. Okay, so I'll try and run through the questions that we have. So the first question is from Subrata. So he says, we plan to set up an AIF. Would be great if the panelists can give the steps towards it and challenges involved. So just bringing it a little closer to the topic that we discussed, I think if I can first summarize, Vikram and Rajesh, your thoughts were the first thing to hit, at least from a tech perspective, is to get your regulatory focus facing systems right. That means make sure all your, I presume, all your, let's say, first calculations, fees, charges, all the financial parts of it correct. And then the second is any reporting that you have to do to the regulators. That would be the sort of first step that you do from a tech perspective itself. And then you'd go into the engagement of that. Beyond that, is there anything else you'd like to sort of add to it in terms of when you're going in and you say, I'm going to set up an AIF, what are the first sort of things that you'd look towards doing?
So what we are seeing is that even the regulators are trying to standardize as much as possible. You know, if you look at what SEBI is doing now, is they're trying to standardize the PPM itself. You know, so if the major components of the PPM are, you know, same, you know, there could be, and I don't think there is a platform yet which can just say that here is the standardized each clause as part of the PPM. And lawyers are still quite active, you know, at that stage, helping build the entire PPM bottoms up. You know, so all the documentation, which I think is not required in my view, because now that things are getting standardized, I think it's again 80-20 rule. 80% of the PPM and the contribution agreement and your trust deeds and all the documentation involved can just be taken from a standardized platform. And you know that SEBI has already standardized these things. So, you know, the lawyer's contribution should happen towards the remaining 20%, which is very specific to your strategy, your differentiation, you know, your overall exit plan and things like those. And which will also be very good for the sector, because, you know, when you're spending time on the things that are, again, this is again core, non-core kind of a thing where, you know, if you actually spend more time on your core strategy, you will actually do a much better job. So I think even now, I think I would say there's an opportunity from a technology business perspective, you know, from Finet perspective, actually to keep standardizing these things on the platform itself. And so that, you know, any new AIFs, and the lots of getting registered now, can just come on the platform and start plug and play and just, you know, put in the, you know, their own over and above what they're going to do. And I think setting up should be very, very easy. Right now, it's taking too long. You know, for example, even SEBI, for example, when you file your application, while SEBI is trying to do its best to process applications as early as possible, I mean, they're still struggling with, you know, getting things, you know, standardized across different applications, etc. So I think maybe in a year's time from now, maybe platforms like yourself, once you actually standardize these things, even SEBI will probably start approving these things much faster. So I'm quite optimistic that we are going the right direction in that sense.
Thanks. So the next question is from Nishan Sugatan. I promise you this is not a planted question. Rajesh, I'll direct this question towards you. So he talks about, you know, asset managers. There's obviously various different systems, there's operational tasks, etc. I'm going to come to the operational part of the question. And again, I assure you I've not planted this. It's how has Finet helped you? Any scenarios? And obviously we, like you said, you've not gone live yet. So, but maybe it might be more useful if you could maybe just tell them about what you expect as benefits that will come in once the system actually goes live as well, so they'll get a sense of what you're looking from it.
Yeah, no, I think this is an easy one. I think systems like Finet, you know, not only help you become more efficient as you know, in your processes internally, but also throw up a lot of data, you know, in a format which makes your decision making easier, or at least data that you need to make those decisions. You know, it becomes very readily available. We can, you know, we over the last 3 years tried to do all of that I shared in the beginning on Google, etc., or Microsoft Office and the likes. But I think what we've seen in the trial runs that we've done so far, and I think, like Finit, there are other systems as well, which we evaluated earlier. I think the role that most of these systems play is that as the fund grows, as the organization grows, as there are, like Vikram is now on his third fund, right? We are going on to our second one, and so every AIF is going to grow as time goes by, which means if your technology systems are robust and in place, they allow you to make even better decisions for old deals that you've done earlier. Because remember, AIF investments are long-term investments. Every deal remains in your ecosystem for a few years. It's unlike the public markets where something comes in, goes out, etc. It's a long-term thing. It really helps you to be in a position to help the underlying portfolio companies. If you understand at one snapshot, what conversations you had 3 years back when you started this, what happened when they raised Series A, what were the promises, what have they done, right? And it's not necessarily those companies which haven't done well, where you need the information to understand and go and correct that. I think it's even more relevant for companies in the portfolio that are doing extremely well, because those are your winners, and you really, when you help them in the right manner based on data that you have, in your system, first-hand data, primary data, I think it's invaluable, the kind of help that you can bring. See, the big difference between, and because I've done secondary markets as well earlier, I think the big difference between equity markets, listed equities, and VC kind of, or an AIF kind of scenario, is that most of our research is primary research. We cannot rely on consultant reports or research reports published, etc., right? You have to have your own research. Now, the quality of your research or the utility of your research, let's say, is better and better if you're able to call that research to action, much after you've done that research. Otherwise, what happens is the whole knowledge management aspect just remains in your mind, and you move on to the next transaction as an analyst, you move on to the next exit that you're working on. How does the system help you capture that knowledge and really build on that knowledge as an organization? So knowledge management, is extremely important, and I see that playing a very critical role. And you can't do that if you don't have a system like Finit.
Brilliant. We've got a rush of questions now, so we've only got a minute and a half left. So what I'm going to do is some of you have asked questions. I think we covered those earlier in the video as well. So, for some of the others whose questions I won't ask now, what I'd suggest is, we'll send you the link for the video. You could see the first part. I think a number of your questions will get answered in that. So as a last question, maybe I think this is something we spoke about. We tangentially touched upon it, so I'll talk about that. So what are the key points, crucial steps that you need to take care of when you're onboarding an investor digitally? You spoke about how you're using Zoom for existing investors. So I suppose, as a new investor, do you see that someone can be done entirely digitally? Are there any risks associated with that you need to establish any controls for? And how would you go about doing that, I suppose, is the question. So I'll leave it to either Rajesh or Vikram, between the two of you, one of you can give your views on it.
When things are going right, nobody wants to open up any of the previous files, right? So, or anything. Even if one case goes wrong, that is the time when people want to go to the history of everything that has happened, right? So, and you will, if you're actually getting a large number of investors on your platform, there could be that one investor who will come and say, hey, I didn't even know that, this is what you guys were doing, and you just took my money, and then, I don't agree with you, and blah, 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 and therefore do something different for me, which your fund doesn't allow, but, you made a mistake. It's your problem. Otherwise, I'm going to write to SEBI, blah, blah, blah. So, if that situation happens with you, the only recourse you have at that point, if you have documented everything, right from your first interaction to the presentation you made, to the documentations you signed, how you signed them, what kind of interactions you had after that, what kind of communication you did, everything needs to be documented somewhere, right? For that one case, you have to do it for everyone, right? So therefore, I think your system has to be such that, your filing of each investor has to be done properly. So therefore, I think what you need is some kind of, and I personally don't believe that we are there yet in terms of the platforms being able to do that. So I think this will evolve and it will eventually happen. We are trying to do that with our own platform that we've created, and we believe that eventually we'll get there. But I think digital signatures, for example, right? I mean, we've seen there are firms, new startups now actually evolving, and the government is also encouraging, all the stamp papers, how do you do digital stamp papers and things like those. All those things have become possible only because of COVID now, right? And I think one should take advantage of that because it saves a lot of time, hassle, going back and forth and everything. And I think the technology allows you to do all those things. And I think these are things which platform like Finet can really move towards, and I think should be the next phase of doing business in our industry.
Perfect. On that really upbeat note, I think we're bang out of time. We're actually about a minute late as well. So thank you so much to all three of you, Vikram, Rajesh, and Smita. I know a couple of you are actually traveling. You've actually taken the time off on a Thursday evening while you're traveling. So thank you so much for this. We could easily go on for at least another hour or so, but maybe next time we'll take some of the questions, and there'll be a lots more to talk about, I'm sure. So once again, on behalf of all of us, a big thank you to all of you on the panel, and thank you to the attendees as well who've come in, who obviously, and thanks for sending all your questions this Thursday evening.
Thank you.
Thank you.
Thanks, everybody. Thanks. Bye.
Bye-bye.
Thanks.